Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. We have a couple of interesting growth and income picks that we want you to hear about now. At least Todd Bunton does. Todd is our growth and income stock strategist here at Zacks.com. And one of them is Stryker Corporation. That's a company that's been around for a while. SYK, the ticker symbol. It's a medical technology company. Right?
Yeah, and they're famous for their orthopedic implants, knees, hips, joint replacement like that. It's a market that's growing, obviously, as our country ages.
As we all get older, yeah.
Exactly,
right.
The baby boomers are...
Don't have to remind me.
But they also have medical and surgical equipment as well. But it's an exceptionally well-run company, high profit margins, a consistent history of sales and earnings growth. And this growth is expected to continue in 2011 and 2012. Analysts expect about 11% earnings per share growth. The company actually expects 5 to 7% organic sales growth. And they expect earnings per share around 363. You can see, I'm sorry, 365 to 373.
Okay.
So the Zacks consensus estimate is within that range. Comes out to about 11% earnings growth this year, 10% growth next year, so you're getting solid double-digit growth. And the company is also very shareholder friendly. They have a history of returning value to shareholders through stock buybacks. They've actually raised their dividend an average annual rate of 32% since 2000.
That's cool.
So they generate a ton of cash. They've been returning that to shareholders. They yield about 1.2% right now, but their payout ratio is just 22%. So that's the amount of earnings that they pay out to shareholders through dividends. So that number is expected to increase as the company continues to generate free cash and matures a little bit. So expect continued dividend increases in the future. And they traded about 16 times forward earnings. That's a discount to the peer group of 21 times.
All right, talk about generating a ton of cash. McDonald's Corporation, MCD, the ticker, you know, they've been around forever.
Yep.
Their story seems to be improving lately.
Yeah, it has. A lot of people are kind of leery of rising food costs. They think restaurants could get squeezed, and a lot of them can, but McDonald's, for some reason, they expect pretty modest food inflation in 2011. In the U.S., for instance, they expect just 2 to 2.5% increase. In Europe, which is actually 40% of their sales, they expect a 3.5 to 4% food cost inflation. So it's really not that bad. It's kind of modest, kind of tame compared to what commodity prices are doing. And the company is actually expanding in the emerging markets. China is a big market for them. They currently have about 1,300 restaurants there. They expect to grow that number to 2,000 by the end of 2013. So that's going to be a big driver of growth for them over the next few years. Analysts expect about 10% earnings per share growth in 2011, 9% earnings per share growth in 2012. And they're also very shareholder friendly. Like we said, they generate a ton of cash. They've been buying back tons of shares. They've increased their dividend at an average annual rate of 27% since 2000. So they're very shareholder friendly. They spent over $5 billion in 2010 buying back stocks and paying out dividends.
Wow.
So they yield about 3.2% right now, very solid yield. You know that's stable. You can expect that dividend check in the mail every quarter. And they traded about 15 times forward earnings. That's a slight discount to the average of 16 times.
All right, do you own either of these?
I do not.
All right, you can check out other stocks that Todd has written about in that growth and income category just by going to our homepage, Zacks.com, and looking over in the upper right-hand corner. All of the current recommendations are listed there for you. With Todd Bunton, I'm Terry Ruffalo.